Investing can seem complicated and intimidating if you're just starting out. There's a lot of jargon, different investment vehicles, and strategies to navigate. But investing doesn't have to be complex or reserved just for finance professionals. This no-nonsense guide will teach you the basics of investing in simple terms so you can get started on the right path to building wealth. What is investing? At its core, investing is taking money you've earned and using it to try to make more money. When you invest, you buy assets that you believe will increase in value over time, allowing you to eventually sell them for a profit. Common types of assets people invest in include stocks, bonds, real estate, and cash equivalents like money market funds. Why should you invest? The biggest reason to invest is to grow your wealth over time. Your money sitting in a regular bank savings account actually loses purchasing power over the years due to inflation. By investing, you can earn returns that outpace inflation and build your net worth. Investing also allows you to make your money work for you, instead of just trading time for money through employment. And of course, investing today can help you save and accumulate a nest egg for important future goals like retirement. Getting started with investing. Before you start investing, you'll want to make sure you have 1. An emergency fund with 3-6 months' worth of living expenses saved up in cash. 2. Paid off any high-interest debt like credit cards. 3. A plan for your investment goals, time horizon, and risk tolerance. With those basics covered, you're ready to open an investment account. The two main types are tax-advantaged retirement accounts. These include workplace plans like 401ks as well as IRAs you can open yourself. Contributing to these accounts provides tax benefits to incentivize saving for retirement. Taxable investment accounts. These are regular brokerage accounts that don't have any special tax advantages. You can open one at any major investment firm. Common investment vehicles. Once you have an investment account, you'll need to decide what exactly to invest in. Here are some of the most common options. Stocks. When you buy a stock, you buy a share of ownership in a public company. As the company grows and becomes more profitable over time, the stock price should rise, allowing you to sell later for a gain. Bonds. Bonds are essentially loans you make to entities like governments and corporations. They pay you a fixed rate of interest, then return your principal when the bond matures. Mutual funds and ETFs. These are baskets of many different stocks or bonds, which provide you with automatic diversification across many holdings. They're lower risk than picking individual stocks. Investing strategies. With the basic investment options understood, you'll need to decide on an overall strategy, such as value investing. Trying to buy stocks that are currently undervalued based on fundamental metrics like earnings and asset values. Growth investing. Focusing on companies with strong earnings growth potential, even if they don't look cheap based on traditional valuation metrics. Income investing. Prioritizing investment income from dividends and bond interest payments over capital appreciation. Asset allocation. One of the most important concepts for beginner investors is asset allocation, how you divide your portfolio across different asset classes like stocks, bonds, and cash. Your specific asset allocation depends on your risk tolerance and time horizon, but a classic moderate portfolio might be 60% stocks, 30% bonds, 10% cash equivalents. Within each asset class, you'll also want to diversify further. For stocks, that means owning different sectors and geographies. For bonds, different issuers and maturities. The power of compounding. One of the most powerful forces in investing is compound interest, when your investment earnings generate even more earnings over time. Thanks to compounding, investing modest amounts at an early age can lead to significantly more wealth over decades. For example, investing just $3,000 per year from age 25 to 65, with a 7% annual return, would give you over $700,000 by retirement. But waiting until 35 to start would cut that ending balance by almost half. So start as early as you can, even with small amounts, to harness the magic of compounding. Managing risk. All investments involve some degree of risk and potential for losses. That's why it's so important to diversify, have an appropriate asset allocation for your goals, and invest for the long term. It's also wise to keep investing emotions in check. Don't panic and sell during inevitable downturns. Instead, automate your investments through dollar cost averaging and focus on your long-term plan. Final thoughts. Investing doesn't need to be complicated, but it does require patience, discipline, and managing your behaviors. By following the fundamentals in this guide, diversifying, investing for the long haul, minimizing costs and fees, and automatically investing regular amounts, you'll put yourself on the path to growing your wealth over time. So don't be intimidated by investing as a beginner. With a little education and the right mindset, you too can get started on building your financial future through investing.